Hey there, welcome to Feel the Boot, the science of startups. As always, I am your host, Lance Cottrell, and very excited to be getting going on our very first live stream. So if there's any issues that come up while we're doing this, please be patient. There may be technical glitches or other things. I see we've got a handful of people on so far, but probably gonna sort of delay things a little bit and just sort of ramble while I wait for other people to show up. I did, though, want to talk about one thing that I've been come up a couple of times just recently with the startups that I've been advising, and it's around due diligence. And it actually is one of the very first topics that I covered on this channel was about staying due diligence ready. And the problems that they were having is they're doing fundraising or getting ready to do fundraising, but they really haven't gone and nailed down all of the details for their fundraise from a legal perspective. In particular, things like board of directors meetings and shareholder meetings. And they can feel kind of silly when you are the only shareholder and the board of directors is literally just you. And you're also CEO. It seems odd to be having a shareholder meeting and board meetings and taking actions as the executive, but it's super important because as soon as you do try to raise money and someone is starting to do due diligence on your business and looking to see, is the company really properly organized? Does it exist? Are all the legal agreements in place? Is the ownership what you think the ownership actually is? How's that cap table put together? One of the things that they're going to want to look at very quickly is, have you in fact authorized all the shares, right? When someone came in to do an investment round and you issued them some new series of stock, was that done appropriately? Did you have a shareholder meeting that authorized the increase in the number of shares and the board of directors took an action to approve the sale and so forth? If not, then none of those things legally happened. And so you may find yourself in a situation of rapidly trying to scramble and fix all of those things and retroactively put them in place. And that can be done. But it's likely to slow you down. You're going to need to get a lawyer involved to make sure you're doing it right. It doesn't inspire confidence in the investor that you're missing some of those really critical legal aspects to your business. So even though it seems sort of absurd when you have no customers and no revenue and no money and it's just you in a room, start documenting that stuff immediately, right? Hold those shareholder meetings, hold those board of directors meetings on a regular basis. I think the shareholders, at least in the United States, needs to be at least annually. And of course, anytime you're creating new stock or amending the articles of incorporation, again, that does require shareholder meetings, and then there should be the minutes of that, and then you'll have all of that in your files. Ideally electronically, so that when someone's coming in to do due diligence, you can just show them that and all of your ducks are already in a row, because getting things together later is super painful. When I had an offer to acquire my company back in 2000, it ended up falling apart, but it was just this insane marathon trying to get all of the documents together. And at this point, we'd been in business for 5 years. So there was a lot of documentation to try to get caught up, all the contracts, all the employment agreements, every single thing about, non-disclosure agreements and, all of those meetings. Fortunately, I did have the minutes from all those meetings, but every other contract as well. It can be hard to put your hands on anything. So getting a really crisp filing system and records tracking system so that you can put your hands on any of those things at any given moment, super important. All right, so I think now that we got a few people here, and why don't I throw it open in the chat in YouTube if you've got any questions or issues that you're interested in having me talk about. I figure we'll start with a little of that with the Q&A section, and then if the questions start to slow down, then I'll invite anyone who has a 1-minute pitch who wants to come on to join me in the stream. and we'll hear your quick pitch and see how that goes. For that, I'll actually be pasting in a link to Riverside FM, which is the streaming tool that I'm using. So you'll actually have to join over there, and you'll need to be on Chrome because Riverside FM only works with Chrome. But it's all in the browser and pretty easy to set up. All right, and while I'm never quite sure how exactly long the delay is. I know that when I'm looking at myself in Riverside, it's in real time, and on YouTube there is some sort of a delay, so I'm not sure how long I need to be talking before anything goes through, and you have the opportunity to then respond. So in the meantime, I think I'm going to want to talk a little bit about some of the mistakes that I see most commonly with companies that apply to me directly for fundraising, or that come into the North Bay Angels, which is the angel organization that I'm part of. And I run our selection committee, so I get to see all of the companies' applications right up front. And I do the initial filtering of getting rid of more than half of them before passing that along to the selection committee to review it, take a look at the application online, which then narrows down to just a handful of companies that actually pitch the selection committee. And from there, we choose between 1 and 3 to actually present to the group. So fairly radical funnel. And it's given me a lot of insight into the reasons why certain companies make it through to present to the group, whereas others sort of get eliminated very early on. And one of the things that knocks a lot of companies out, I should be pitching this, fill the boot mug. One of the things that gets companies thrown out of the process is often that they're just not candidates for angel investment. And this is sort of, I think, something that a lot of folks don't understand as well as they need to. But there's only a certain kind of business that really is amenable to angel or VC investment. It has to be a company that's moving into a large space. It has to have potential for enormous growth and high returns. Right? Angels are typically looking for at least 20 times their money. VC are often looking for 50 to 100 times their money back, and angels wouldn't object to that either. Most good businesses, you could have a restaurant, even a chain of restaurants, or an electrical contractor or construction industry, or any of these kind of businesses can be amazing businesses, generate lots of money for the owners, and be very successful, but don't have that potential. Right? They're not going to become a unicorn. They were worth $1 billion, and they're probably not driving towards an exit. Right. So as an angel investor or a VC, I'm investing in this company, and fundamentally my funds are just locked up. I have no access to them until there is a liquidity event and the company gets sold. Then I get paid, then all the other investors get paid. But again, most companies aren't really being built for that. If you're starting a construction company, you're probably planning on running it for decades. Maybe you're even thinking about passing it on to your children and having them take up the same trade. Well, that doesn't work at all for this kind of investor, right? We're not looking typically to get some small interest rate or get paid dividends, although there are investors who are interested in that. It's a very different kind of investing where you're looking for real returns, and typically then that's not a startup, right? People, if they're looking for lower returns, also are looking for commensurately lower risk. So if I were to invest in a company that was going to be paying me out on a regular basis, I'm looking for something that is much lower risk, either a well-established business that just needs some capital for some reason and has the ability to pay that back, or an inherently lower risk scenario. So real estate is a really common one where people will invest in that because the underlying asset, the real estate itself, is there. And so the odds of this suddenly evaporating and going to zero are extremely low. And that's the kind of deal that I'm more interested in doing for that kind of lower returns, right? Better than bank returns, better than maybe bonds, but nowhere near the kind of upside potential you have with some SaaS startup that is going to be valued at 20 to 50 times earnings, and they're growing like a rocket ship and driving towards either an acquisition by one of the big players in the space or an IPO or something like that. But in any case, a fairly short time horizon to being able to get my money back out. All right. I'm not seeing any questions being popped into the chat in YouTube, and I'm not really sure whether that's because you don't have any questions or because there's some technical difficulty. But in any case, I'm just going to keep on talking, and if anyone wants to pop in and interrupt me, please do. I can talk about just about any topic. I see a lot of companies really focus on getting angel investment to the exclusion of all the other ways that they could be funding their company. And I think that's also a common mistake, is just to get obsessed with the classic Silicon Valley approach. And it can end up having you give away far more of the company than you probably should. You can start to lose control. You've now got bosses that are breathing down your neck. Whereas if you follow another path, for example, if you get grants, a lot of companies can use grant funding to build the business. If you're in some sort of socially beneficial kind of business, it's green tech or supporting the military or other things like that, there are often large grants that are available to startups to fund their business, and that don't come with any ownership, right? So you're not bringing someone onto the cap table. It's not diluting you. It's not diluting anyone else in the business. There are often strings. They require you to work on the thing that you said you were going to work on, and there's an application process, but that can be hugely valuable. Similarly, other businesses may be willing to pay you. I know companies that have gotten hundreds of thousands of dollars to pay for non-recurring engineering expenses to build out the solution that their customer wanted. It could either be the whole solution, or it could be some new set of features that customer really wants to exist. And so they're willing to pay for that. And maybe that will be offset against future income from them, right? So they give you $100,000 and you effectively give them $100,000 in credit for the service that you're going to build. But that can give you the cash immediately to build out the solution that you want without having to bring on investors in the longer term. Debt, of course, is an option depending on how much money you need. There's lots of entities out there, obviously lots of stories of people building their companies on credit card debt, but there's other lenders that specialize in supporting startup businesses. Many states have programs around that. That can be a great way to bring in, say, $20,000 to $50,000, which is not as much as you probably raise in an angel round, but it might be enough to get your solution built to the point where angels would be interested. You do more validation, you've finished out your MVP, maybe you've got some traction, maybe you've got some paying customers, and that would then allow you to raise the larger round with much less dilution because you've accomplished more at this point. And that debt can then be repaid from the cash that you've developed. And finally, you can bootstrap. If your business is the kind of business that allows you to start generating cash fairly quickly, then moving in that direction can be a great option because it effectively gives you infinite runway. Right? If you can generate enough cash to actually pay for the business and cash flow things out, then you're never up against a wall. You're not going to be over a barrel hoping that you can raise that next round at a good valuation. You now are in control. And if you want to raise a round to fund expansion or marketing or something like that, you have the choice to do it, but you also can walk away. And that puts you in a far better negotiating position and probably gives you much better valuations. And plus you can better negotiate things like control and board seats and all of those issues. So just got a text in asking about crowdfunding. Crowdfunding is a really interesting twist on all of this. And there's sort of two flavors of crowdfunding for equity, right? Separate from things like Kickstarter or GoFundMe or other things where it really is more of either a donation to you or a pre-sale campaign with Kickstarter. Crowdfunding can either be with accredited investors, so people who are high net worth individuals who have, in theory at least, the sophistication to be making investments in startups, or are brokers. There's several ways that you can demonstrate your accredited status. Those typically are looking for larger investments, so it's thousands of dollars to tens of thousands of dollars going into it. Or there are other forms of crowdfunding that don't require people to be accredited investors. That can go much, much lower. So at that point, you might even be taking $100 from your typical investor and making it up on volume. So at this point, you need gigantic numbers of people coming into the crowdfunding platform to close out the round, assuming you're needing to raise a substantive amount of money. So, let's say $100,000 to $1 million. And the need to have that number of people is really the catch-22 of crowdfunding. I've seen a lot of people try it, but if they don't have a large audience already built in, it is incredibly challenging to get those numbers in place. So you either need to have that audience, you've got some free service with a huge number of active users, or you're an influencer already and you've got some enormous number of followers, some fraction of which will convert into crowdfunding users. Or you can beg or borrow that kind of audience, right? You bring in an influencer or a partner who has the kind of reach that you need to allow you to put out this gigantic number of, pull together this large audience so that the number of conversions will add up to the amount of fundraising that you're trying to achieve. I've actually seen a lot of people use crowdfunding almost in a backwards way, where they do the crowdfunding as a marketing effort. So they're going to go out and raise some money. They don't really care how much, although of course it's always nice to raise more, but they're going to focus on generating super fans. So people who are ponying up a couple $100 to a couple of $1,000 to invest in the company, they're now part owners in that company, and they will behave appropriately, typically, right? They now feel like they're part owners. They're going to be interested in the company. They'll be supporting it. They'll probably be using the solution because, they're investors. They want to see it succeed. And they're going to tell their friends about it. They're going to want to brag about their involvement in this company. And so if you're at a point where you can reach out to a large population of users, maybe they're even currently customers and paying users, and get them to become investors as well, that really can solidify that connection to you and also make it stickier, right? They're much less likely to churn off your platform if they're investors in the company, even at a very modest level. And apparently I'm not seeing the chat as it comes in. Interesting. I wonder why. Aha! I needed to click something else on here. Okay. All right, now we got a bunch of things here. Max Rex Music is asking what the most important financials to cover while pitching. So far he's highlighting total customers, numbers, actual subscriber numbers, revenue, expenses, salary. Yeah, I think that's going to be the key numbers that you're looking at, certainly at a pre-seed round, right? So you're pretty early on. I want to understand how many customers you have, how much actual cash that's generating, and I want to understand kind of the unit economics of your business. Where are your expenses going? How much is going to salary? How much is going to marketing? How much is going to cost of goods sold? If it's a SaaS company, that would just be the cost of the servers and the cloud and so forth that you're paying for. But I don't like to see people go overboard with projections at this kind of really early stage, because I know they're BS. Right? I know that the numbers that you're putting down now are going to be laughably wrong in 6 months, 2 years, 5 years. I mean, 5 years is just utter fantasy. So trying to keep it fairly simple, knowing that the details of what you're saying are off, but demonstrating that the core fundamentals actually work. That, it's not a theoretically impossible business, that your COGS plus your marketing expenses will be less than the amount that you're bringing in from customers. Or at least will be eventually, right? It's very common for startups to be losing money, almost universal for them to be losing money early on, sometimes because the unit economics and the economies of scale aren't working out very well. And so if you can demonstrate that you've done the research to show that although currently you're losing money on every sale, once you have more than 10,000 customers, that this becomes a very profitable kind of business, that's fine as well. But yeah, really we want to understand the way the business functions. And frankly, your financials and financial projections say a lot about how you understand the business. And so to a great extent, when I look at financials, I'm trying to understand what you think is important about the business and how you've approached it. And that might show me things I like. It might show me things I don't like, right? It might show that you're really obsessed on certain parts of the business and have totally ignored other parts of the business that I think are critically important. So fairly lean, but capturing, the core economic loop. What is the money-making transaction and how does that function? That's the stuff that I really want to see in there. So what ways can a startup get traction for angel investments? Emails, actual sales, etc. How many people should be interested to use your product? Of course, it varies a lot depending on whether you're a consumer business or B2B and kind of what the dollar values are. If this is a very high ticket kind of service, or you're selling to big companies, and it's going to be a large aggregate enterprise sale, then you can demonstrate excellent traction with fairly few of them. On the consumer side, typically we're wanting to see more, but really even hundreds of active users, as long as that number is growing strongly and the economics of bringing them in looks good, is viable. Ideally, we want to see customers that aren't your friends and family. You can get, right? You're already hand cultivating people. We want to see that people who don't have pre-existing relationships with you are also interested in adopting the solution. And depending on what the kind of solution is, are they sticking with it, right? So for example, with app downloads, it's often easy to get people to download your app. The real question is, are they still using it in 3 weeks? My phone is packed with apps that I never use. There are hundreds and hundreds of them. The number of apps that I use on a weekly basis is probably under a dozen. And I think that's fairly typical. If you don't have the product out yet, it makes things much more difficult to raise angel, but not impossible. So things like, as you mentioned in your comment, email lists, waiting lists, people who have signed up, to be alerted when the product is available, or letters of intent from B2B customers, all carry weight. They carry less weight than someone actually paying you. But depending on the nature of the business, if it's not reasonable for you to be able to get there, then these can be fallbacks. It does make angel investment more difficult. So getting the investors to come in is more challenging at, the earlier stage you go, the fewer angels are willing to step up. There's always going to be someone somewhere in the world who would probably invest in you, but it just becomes exponentially more difficult to find them when you haven't sort of hit those milestones. And there's actually a great article that NFX put out talking about the ladder of proof and sort of the different kinds of validation that your company can have that will interest investors, roughly put in order of priority from most valuable to least, although I think each investor may have their own sort of preferences around that. If you go to feeltheboot.com, I believe I have a link to that in the resources section, along with a couple of other things that I found that I recommend to people a lot. And so just like the topics for episodes tend to come out of questions that I've gotten a number of times, the information on the resources page also, when I've shared something 3 or 4 times, I try to remember to put it up there. So someone's asking about the live stream setup. So when we're getting ready to do the live 1-minute pitches, I'm actually going to paste in a link for you to join the Riverside FM channel as an audience member. And from there, I can invite you in, and it'll actually just do a split screen and give you an ability to do that direct pitch. So I'll paste that in a little bit. But yeah, I'm not sure how to do it with YouTube, but I know Riverside can do it, so I opted to put it there. And actually, I love that you guys are starting to answer each other's questions. So pre-product, you can't have active user stats yet. I think surveys are going to be really key. Pre-signups on mailing lists are going to be key metrics. Pre-orders even, right? You might see if you can get people to pay in advance, unless this, of course, is an advertising supported thing, in which case that doesn't work. I recommend spending a lot of time when you're doing interviews and discussions with potential customers to dig into reasons they wouldn't buy. Right. Understand where are the resistances, where are the concerns that they might have, where is there going to be pushback on that, so that you can tailor what you're doing to get ahead of that. Right. When you're talking to a customer, you're already cutting off the objections because you know what they're going to be, and either they're not relevant, and you can sort of explain why, or if they are, you can be modifying your product, either what it does, how it's implemented, how it integrates with their systems, how you price it, how they pay for it. Any of those might be blockers. The more you can learn, the better off you are. And being able to talk about that in your pitch is compelling and comforting to the investors. Right? We really like to see that you understand your customers at a very deep and fundamental level, because that improves the chances dramatically that you'll be successful in landing them once the product actually comes online. And a question about whether you should be sharing the cost of all expenses combined or break them down. In a pitch deck, keep it real simple, right? I would say just aggregate it all into one bucket, or kind of depending on what are the really important things. So there might be salary costs and cost of goods sold, or bandwidth costs or servers or whatever the big chunks are, and ones that will scale very differently. Right. Some of these are going to be fixed costs. Some of these are going to be variable based on the number of users you've got. I think it is useful to break it out at that kind of level, but I really keep it as simple as you can. And especially in a pitch deck where it's going to be on a slide, if you're pitching live, you don't want someone trying to squint and read small text over your shoulder, right? A whole spreadsheet is completely inappropriate. So my inclination is to say strip it all the way down as far as you can to still provide kind of that key understanding of your business. And then you can put in more detailed financials as an appendix slide. Now, when you're sending a deck out to be read on its own, if you're emailing it or uploading it to some platform, then you can get a little more detailed. But even so, it may be getting looked at on a phone, or as a small embed on a page. People are a little bit of allergic to too much text. So again, generally you want to keep things pretty low levels of content, really skimmable. And that actually applies to the whole deck, right? Decks need to be highly skimmable for the investors to be able to look through it. And I think it's pretty common that we'll do, for worthy companies, a several pass process on the deck. So when I get a deck, the first thing I'm going to do is effectively just flip through it and look at the headlines, really, really fast scan, just to see, kind of all the content's there. It looks like an interesting business. It's roughly at the right kind of stage for my investments. Kind of checking quickly for disqualifying characteristics. Then I'll go back and maybe look at the headlines, look at the high level, key numbers that you're calling out on the slides. And if that still looks interesting to me, now maybe I give it a more thorough read where I'm going to go all the way through it. And the deck really needs to support all of those modes of consumption well. Because if I come on the deck and I'm seeing walls of text, I'm probably not going to read them. And if that's where all the important information was, then after that first scan, I'm probably just closing that and moving on to the next one, because I see so many of them. I get so many pitches that I don't have the attention span to dig in and see whether there's actually a diamond hidden in there or not. As soon as I'm sort of overwhelmed and not able to immediately kind of get an understanding of what's going on, I'm on to the next one. And doubtless I missed some good opportunities, but even so. All right, so what are the three most critical factors in fundraising? Traction is definitely number one for me, right? I want to see that you have customers who want what you're doing, and that this solves a problem that they can't simply solve other ways. Because remember, often your competition isn't, in fact, some other startup or some other business. Your competition is often just the status quo. Like, I've seen some really cool SaaS companies with amazing dashboards for collecting and managing certain kinds of information. And their competition is Microsoft Excel, because that's how most of their current customers are solving that problem. And the problem is, it works well enough, right? So you need to be a lot better. A lot better in the eyes of your customers, because of course you're a startup. That means you're probably going to fail. Bad news. But your customers know that. And so getting them to adopt a solution from a company that may not be around in 6 months is a hard sell. And so you need to be vastly better than what they're doing now, or open up, huge new opportunities which are extremely valuable to them, for them to want to jump on that. And I'll want to see that. The team is important, right? I need to sort of believe that this group of people can execute on the problem and successfully deliver an outcome. They will be able to build the product, sell the product, run the business, do hiring, do all of those kind of things. Makes it hard for first-time entrepreneurs, right? One of the best ways of demonstrating that your team is a great team is that this team has done this a couple of times before with reasonable success. Although even startup failures are not bad. Having been through the startup ringer a couple of times, even if it didn't work out well, is actually a really good sign for an investor, because it means that you've been there before. You understand how these things work. You've hired, you've built, and you've learned, hopefully, from the mistakes that you made in the previous businesses. And so now you have a much better idea of how to manage cash flow, or how to deal with your in-house or outsourced engineering resources, or whatever that may be. I really like to see a very distinct insight from the founders. Right? What is it that you understand about this market that other people are missing? Where is this gap that you're coming in to fill? And it could be a lot of things. It could be, if you're a deep tech company, you're bringing in some new fundamental technology that doesn't exist that's going to solve these problems. But you might understand something about pricing, that everyone else is pricing on a per seat basis, and you realize that you can disrupt the whole market by coming in and pricing in a radically different way. And often it's very difficult for the established players to pivot into that, maybe because it would actually mean they'd lose a lot of money. And that's how you're competing, is you're going to be the low cost leader, or at least you can bring people in at low cost. So that's a critical one to me. The opportunity has to be big enough. We need to see that 20 to 100x potential return. And so I need to sort of believe that the market's big enough and that the structure of the market will allow you to grab a big enough piece of that. And so that comes down to sort of differentiation, defensibility, and strategic power. Is this something that anyone else could build and jump in and start competing with you successfully? Then I am more nervous to invest, right? Because it probably means you're going to have a harder time grabbing and holding on to, the whole chunk of market that you want to get. I mean, I think about some of the valuations we saw on internet orderable mattresses, right? There was that big mattress bubble that happened. And the first company that came out made lots of money, grew like crazy, got tons of investment. And what do you know? Suddenly there were a dozen other mattress companies selling very similar kinds of products, undercutting them, diluting the market, driving down margins. And it turns out that was not a great thing because there wasn't anything about the mattress selling process that was particularly defensible or sticky. Anyone could come in, hire some engineers, go to one of the contract mattress manufacturing companies and have some mattresses made and compete on a pretty even basis. So you want to make sure that you can tell me a story about why that's not likely to happen, right? And there can be many, many, many reasons, but some kind of defensibility. Network effects is a classic one, right? No one competes head to head with Facebook because everyone's on Facebook. The other social media companies that have come in to compete with them are fundamentally filling a different niche, right? They're not interchangeable goods. So people are on Twitter because Twitter gives them a very different experience than Facebook, but that doesn't mean they're not also on Facebook, right? So they're not necessarily substitutable goods, but network effects can be a big one, right? Someone tries to come in and start a new business to compete with you. It just is less valuable because they have less other customers on it. Marketplaces are like this, right? On a regular basis, if you have every vendor on there, well, that's great for every customer because they can get anything they want. Whereas if someone's trying to spin up and they only have 2 or 3 vendors signed up already, well, that's actually kind of a lame marketplace and no one's going to want to go there. So you're in a good position having that established marketplace with that first mover advantage. But other businesses, the first mover advantage doesn't even help, or often the winner is what they call a fast follower, right? So someone sees you launch, sees the opportunity, sees what you're doing wrong, and launches their business to compete with you, fixing that 1 or 2 things that you got wrong because you didn't know how to do it the first time. So yeah, we want to see, why is this company going to have that opportunity? Those are the big ones for me. Financials at gap materiality, 5% or greater categories. I'm not, as a startup, I'm more interested in cash than gap, so I don't worry too much about that. Materiality, 5% is kind of low, well, especially at the pitch deck level, right? At the pitch deck, I'm looking for things that are 30 to 50%, of a given category. For due diligence, I will want to see it broken down more. So you end up having kind of this super high level sketch version of what it is that your company is going to be doing, and then a much more detailed version that you can share with them when they want to understand, okay, you said it's all, 50% of your expenses are headcount. All right, what does that look like? And, how much are you paying the founder? Because we don't like to see the founder paid too much. Right? We want to see the founder hungry, but not starving. There's a deal that I've been looking at just recently that I am probably not going to invest in, and a fund that I'm involved with is not going to invest in for sure, because of the compensation to the current management team. They're being, basically paid market salaries. They're being paid quite well. And that means that their interests are not as aligned with me, right? I want the founders' interests to be aligned in that their payday comes when my payday comes. But I also don't want them starving, right? You need to cover your addiction to food, shelter, and clothing. I don't want you to not be able to work because your car broke down and you can't afford to repair it, or something like that, right? So we want to make sure that you are able to stay focused. I mean, I saw one founder who was actually looking at driving Uber on the side just to make ends meet, right? That's not ideal because it means he's spending less time on the business. And we want you to be able to be full time in the business. This is a big disadvantage for founders who are not, college-aged people. You're older, you've got a mortgage, you've got a couple of kids, maybe you're saving for tuition for them to go to college. You now have kind of a much higher minimum threshold, maybe higher than investors are going to be comfortable covering. If you've got a spouse who's got income, that can help. But it is just much more challenging, and you're taking a bigger risk, because you have more to lose. When I started my business, I actually sat down and talked to my wife about this and said, I want to start this company. It's extremely high risk, but if it all goes terribly wrong, I can just go back to grad school. She was in grad school already. We didn't have any assets to lose, really, so bankruptcy wasn't going to kill us. I mean, it would hurt our credit rating, but we could rebuild that over the following decade. We had good fallback plan Bs, so we could afford to take that risk. Whereas, if you've got a mortgage and a couple of kids and all that stuff, then suddenly there is a lot to lose, right? You can lose the house, you can lose, all your investments and the funds that you're trying to sock away for specific purposes, your retirement, things like that, are now vulnerable. Can investors see through a mediocre presentation? Well, we certainly try to. It depends on how clever the presenter is and how flim-flammy. Obviously there's a lot of mediocre companies that get funded. There's fraudulent companies that get funded. Think about Theranos. And why did no one sort of do enough due diligence to see that there was no there, right? That in fact they weren't creating these microblood tests that would do these amazing things. It is definitely possible to bamboozle some investors. It also gets out, right? So if people know that you are less than ethical, that will stain you forever, to the extent that gets out into the community and kind of becomes a known thing. And certainly it's one of those things I ask about or Google about when I see someone. You try to find out what the background is and what's going on. And often, we're trying to ask good questions that will reveal whether or not you actually know what you're talking about. So, you may say, it's going to be this size market and we're going to achieve 10% of it. And then the follow-up question is, why 10%? And what makes you believe you can achieve this? And, what tests have you done? What evidence do you have? And if you don't have that, then that kind of falls apart. Although I could be misreading this question. The flip side is, can we see through a mediocre presentation to see a good company? Sometimes, but unfortunately, we're human. The quality of the presentation definitely colors our opinion. If everything is really tight, it's an attractive deck, you present well, you're clearly articulating the messages, the presentation is well organized and thought out, so everything kind of happens in a structure that makes sense. That really amplifies the message that you're sending and makes your company look better than perhaps it deserves to. Whereas similarly, with a mediocre presentation, it's harder to see. And there may be great things about the company that we won't even know because you didn't mention them or didn't highlight them or raced by it quickly. And we might ask the right question to get at that and realize that there's a there. But in many cases, it just goes by. Although, I actually did have an application to the North Bay Angels last year. And they were a local company. They were sort of in a space, they were in the wine industry, which is, I'm in wine country, so that was interesting. And their deck was a train wreck. It was a disaster, but you could see some indications that there was something interesting there. And so I actually reached out to them and said, you're not applying to this cycle in the investment group. Let's sit down and let me give you some feedback and coaching and improve your deck and see if this will turn around. And with a much better deck, they then came back and made it through all the way to present to the group, and are showing some pretty good traction at this point. So it does happen, but not a lot. Yuri, yes, you can ask questions here. Please jump in and post any questions you've got. A question here about how to deal with sort of an oversubscribed round. So if in the case of multiple investors wanting to come in for more than you want to raise, and that's fantastic, right? So this gives you potentially the opportunity to negotiate with them, right? It might suggest that you want to raise your valuation a little bit, but also it gives you the opportunity to be choosy about who you let onto your cap table. Anyone who's an investor in your company kind of has a right to get in your business forever, right? Until there's an exit. And someone who's kind of a pain in the ass will really ruin your day, right? They can take up a lot of your time. They can be distracting. They can sort of be pushing their own agenda, which will take you off point and off message. So you want to be thinking about who are the people you want to be working with over the next couple of years, and who can bring the most value, right? Looking at, do they have connections or experience, or are they willing to sort of be an active advisor, or, would they be an asset to you to have on your board of directors, and really targeting in on the ones that you want the most. And of course, you can oversubscribe. So if you said the round was going to be for, we're raising $800,000, and you've got investors totaling up to $1 million, you can choose to take $1 million, assuming that you have the buy-in from your current investors or your shareholders. But you could either, when you set up the round, pre-build it so you've got some headroom if you want to take more investors, even though that's not what you announce, or you go back to the current shareholders, have a shareholder meeting, and expand it. Another thing that you will sometimes see is when rounds start to get oversubscribed, they will cut what they allow everyone to take. So you go in and say, I want to invest $25,000, and as the CEO, you might go, we actually have had to cap everyone at 20. Or we're taking a smaller amount from everyone. Typically, you're better off being choosier with your investors and keeping the investment amounts high, just because more people on the cap table is kind of a pain in the ass. Right? It's more people who can hassle you, more people you need to report, send reports to, more people you're trying to wrangle for votes. And there's also some tax implications and some legal things that trigger at certain numbers of investors. So you'd like to keep those numbers kind of under control. It's one of the reasons why with crowdfunding, they're not actually investing directly in your business. They always invest through what's called a special purpose vehicle. So effectively, there's a company, an LLC usually, that's created. Everyone puts their money into the LLC, and then the LLC invests in your business. So from an investor cap table perspective, there's only one investor from the entire crowdfunding round. It's that entity, and then everyone else is part of that. And so that helps you get around these things. And sometimes it's actually even worth doing outside of crowdfunding, right? If you're starting to get a lot of people who want to come in, or people who you would like to have on board but want to invest smaller amounts, it can be economic to set up a single purpose vehicle, a special vehicle, to allow them to do those smaller investments without crowding up your cap table. And then you don't need to reach out to all of them for their votes on any issues. It's whoever is authorized to vote for that SPV that carries everything right there. Someone's asked if they can share their pitch deck with me. Not here. I only want to do sort of one. Oh crap! We're almost out of time too. Sort of 1 minute elevator pitches, but if you go to Fill the Boot, sign up for the mailing list, you're more than welcome to grab some time on my calendar. I do free office hours, and I frequently will do deck reviews there. Or if you contact me on LinkedIn, I'd be happy to give you an email address, and you can email me the deck, and I can take a quick look at that and give you some feedback as well. I do a lot of looking at decks. And speaking of, if anyone has a pitch that or rather an elevator pitch, right, 1 minute only, that you want to try, I just popped a link into the chat so that you can join the Riverside channel, and that will allow me to bring you on, and it will give you video and audio through Chrome so that you can join if anyone's interested in doing that. Do we have someone here? In the meantime, let me take a look. How should an entrepreneur qualify a potential investor to ensure they're worth talking to? Yeah, so like I said, you do definitely want to be doing due diligence on your investors at the same time as they're doing it on you. So you want to see that they have made other investments. Typically you want to work with people who are active investors. This is not the first investment they've ever made. Those are often a pain in the ass because they're not as familiar with the way this whole thing works. And so their expectations will often be sort of out of whack with respect to what the norms of investor involvement would be. And if they've invested in other companies, ask for references. See if you can call or talk to some of the founders that they've invested in recently to get their take on it. How was this person? Did they deliver value? Did they actually help the founder grow the company? Were they a flaming asshole? Were they really problematic? Were they pushing for sort of insider deals or things like that? You want to understand what kind of experience you're going to be getting into, and so talking to the other founders is key. Google them, see what people are saying about them online, and then look for other investments that they've done. And that can also tell you, in terms of approaching them, who is investing in your kind of space and at what stage. If every investment they're doing is crypto gaming companies as tokens at pre-product stage, don't bring them a food and beverage deal for stock at a round or something like that, right? It's just, there's no way it's going to be a good fit for them. We're a deep tech company, but not a valley tech company, so we don't have a ton of referrals. I think networking is going to be a huge thing there. It's 5 degrees of Kevin Bacon. You're not that many hops from anyone. And so getting into those communities, getting involved, becoming a thought leader in these spaces can help you connect with the people who might be customers, who might potentially be investors, things like that. Depending on where you are, especially at the pre-seed level, many investors prefer to invest in companies local. Right, so things that are within driving distance of where they are, so that they can come out and kick the tires and see what's going on. So even though some of your best investors might be out in Silicon Valley, you may want to start local with some people who are connect with the university near you or something like that, and then slowly expand out. Although since COVID, I think that has broken down a lot because people are now much more comfortable with doing everything virtually, doing all their meetings on Zoom, and then geography sort of is less important, and maybe I just ask you to give me a virtual tour of the factory that you've built and walk around with a phone or something like that. So there's a lot of ways of attacking that. Hopefully that was relevant to the question you were asking. If you're bringing on more investment than you were originally asking for, can you raise the valuation? Generally not, right? So if you've got a lot of people who have soft circled, and so or firm committed to your round, they probably committed on some terms that you'd already set. And especially if you've got a lead investor, which hopefully by the time you're getting oversubscribed, you do have a lead investor, they've negotiated the terms with you. They're probably not going to be happy with seeing those terms kind of changed. They'll want to have those stay put. So yeah, you're going to take additional dilution if you bring in more money. Hopefully you've set the terms and the valuations such that that's not ruinous. You're selling, maybe you were planning to sell 20% of the company and now you're selling 25% of the company. That's probably fine. Those little tiny percentages don't make too much difference, as long as you can deploy that cash effectively, right? So you would not want to take oversubscription if for some reason you don't have any good way of using that money, right? You're not going to be, having some high burn rate. You're going to be break even by the time you spend this, and then you're not planning to raise more. Then you wouldn't want to raise more. But everything takes longer than you expect and costs more than you expect. So you've got some idea of what it's going to take to get to that next round. You're probably wrong, right? It's probably going to be longer to get launched and get growth. It's probably going to take more money, so you're going to be spending faster. Raising that next round will probably take longer than you expect. So having a little extra runway can be huge. So yeah, maybe you're taking a little more dilution right now, but in exchange, that might be lowering the odds of catastrophic failure by 30% or something like that, because you now have bigger cash reserves. And that can be a really good trade-off, worth really thinking about it, that ideally the money you're bringing in brings growth far in excess of the dilution. So you're getting diluted by a quarter, but if that quadruples the size of the company, that was a fantastic trade, right? At the end of the day, your ownership stake is worth a lot more. And I think I did a whole episode on this, people get way too obsessed with ownership percentages that, I need to have 51% or 50%, or I don't have control anymore. But if you've got a number of different investors who are not, one entity, moving in lockstep, then it really isn't that number. Because for most votes that you have, right, if you're doing a shareholder vote, and that's the only time the shareholders get to weigh in, many people don't vote, right? So a lot of those people won't bother to vote in that shareholder election. So as long as you've got a quorum, your effective percentage is much higher than you would have thought. And then ideally, you're not doing anything stupid, so probably many of the people are going to want to vote with you. So the only time having 49% means that you don't have control is if the other 51% owners all show up and vote, right? 100% turnout, and they all vote against you for some reason. And if 100% of people bother to turn up and vote against the thing that you wanted to do, they probably have a good reason. Right, you're probably doing something that is, not in the, you're not being a good fiduciary for them. And and once you bring in investors, you are responsible to them, right? You are responsible for making sure that you are taking care of them appropriately. Hopefully that was useful. Get distracted when I go down these long rabbit holes. Oh, Max, yeah, Safari. Unfortunately, I'm on a Mac too. Safari does not work with Riverside, so you won't be able to log in that way. Larry's asking about how many pitches do successful founders make before closing a deal. Typically, you can expect to do hundreds of pitches before you close your round, right? On average, it is not at all uncommon for people to be over 50 pitches in before they get their first yes. and let's say you're raising $800,000, your first yes is probably for 25. So you're going to need to get a lot more of those yeses. Typically, there've been some interesting articles talking about how this plays out and looking at some real data. Normally, there's kind of a hockey stick to fundraising. So getting that first person is like pulling teeth. Getting the second one is almost as bad. Once you've got a handful in, now you can sort of start talking about the fact that your round is starting to fill, you've got some other investors, and investors like to follow other investors, right? There's definitely a herd sheep kind of effect that goes on with that. Once you get a lead, things change a lot, right? Now you've got someone who's probably going to be the largest investor in the round, someone who's sophisticated, someone who is willing to step up and both do the negotiation with you, but also is sort of putting their reputation on the line, right? When you take a lead position, you are saying, I believe in this and I am endorsing this and I think other investors should come in. That lead will often be helping you fundraise, right? They'll be reaching out and making introductions because they're enthusiastic about the business, at which point you're typically then starting to see everything fill up and it can end up closing pretty quickly. But yeah, on average, it's hundreds. This is one of the reasons why I recommend that you don't start pitching your best prospects, because probably your pitch sucks at the beginning. And you'd hate to go to that perfect person and then fall on your face in front of them. Go find someone who is in no way your perfect person, but is a viable prospect, and pitch them, ask for feedback, watch how they respond to what you're doing, and then you can slowly iterate that over time. And when things are really feeling good and solid, you're getting very good feedback, people aren't getting confused, they're not asking dumb questions because you are in fact answering those and making sure that they understand things properly. Now you can really start reaching out to your better prospects. And there's a lot more people who are doing pre-seed level things than used to be, right? So there's a huge number of angels out there, individual angels, angel groups, angel networks, but then also there are micro pre-seed VCs, so venture capital funds that are focused on investing at extremely early stage businesses. And that is a fairly recent development, but they're spinning up like crazy now. The funds tend to be a few $1 million, maybe a total of 10 million, but that means they're able to make those small investments, right? They can put in $100,000, $200,000 into a company, whereas a large venture capital firm with a multi-billion-dollar fund, they really can't deploy small amounts of money because it's too much work. And so they're only going to want to put in kind of very large checks. And so that restricts the kind of stage that they can invest in, because no one wants to write 10 million to a pre-seed. Let's see. I have a pitch day coming up tomorrow. No current terms have been currently set, and you haven't met any of the investors. Well, that's excellent. I mean, that's very exciting. When you are, talking at the end, when you hit the ask, I would sort of suggest saying that, we're looking for a lead investor who to work with us to negotiate terms or something like that, unless you already have some pretty clear outside guidance around appropriate valuations. Don't lock that down. Hopefully the accelerator's done a good job of prepping you, giving you a lot of feedback on your pitch and on the deck. I mean, I think that's a lot of what many accelerators and incubators focus on. I know with Founder Institute, which is the one that I'm involved with very heavily, a lot of the program centers around doing pitches of various lengths and really getting that nailed down, getting feedback from the mentors and retooling that, both of course around the pitch itself, but also around the business and the business model, and making sure that the business model makes sense and that you're articulating that well so the audience can understand it. Are there successful brokers for angel round deals that work for a cut of the deal rather than cash up front? Yeah, there are a lot of people like that. How successful they are, that's another question. A lot of people will say, oh, I've got a network of, 200 angel investors that I syndicate deals out to, and so if you give me 10% of the results, I'll reach out to them. Full disclosure, I am on those lists for a number of brokers, and that doesn't mean that I'm all that interested in the broker or interested in the deals that they send me. I'm always sort of open to seeing more deals come across my desk, but they don't have some magical close connection to me, right? They're not a really highly vetted, warm introduction to me. In many cases, someone coming to me that way almost makes me question why they couldn't network their way into better introductions, or finding other people to help them with their fundraise rather than just paying out of pocket for an organization like that. But at the same time, there are in fact ones that are, I think, legitimate and good and do have a strong cohort, but you're going to want to do a lot of due diligence on them before you pull the trigger, because I've seen way more companies that sort of end up with a deal like this and then get nothing. And sometimes the contracts are written in kind of a nasty way, so that if you close any funding within a year or something of when you sign this contract, sometimes even much longer, they get their 10%, even if it was not someone they introduced you to and they provided no value whatsoever. So there can be some real gotchas in those. So make sure it only applies to deals they bring you, that you can terminate if they're not bringing in good investors in a timely way, and so forth. Oh, someone's asking for my LinkedIn. Yeah, Lance Cottrell. Was it linkedin.com/in/Lance Cottrell? That will get you my contact there. How do you identify pre-seed, micro, or VC entities? Google is your friend, right? They are hungry for deal flow. They're looking to find good companies to fund. They're always on that kind of a hunt. So they will have websites that advertise what they're doing. So if you sort of Google pre-seed venture capital or pre-seed fund, things like that, you will find them, and then narrow it down based on target, because a lot of these have very specific investment theses for the kind of businesses they want, right? Some of them will be only Latin America, or some of them are only deep tech, or some of them are only crypto, or what have you. So that narrows things down a lot, but these are popping up like crazy. There's an adjunct to Founder Institute called VC Lab, and they are basically an accelerator for micro VCs. And their plan is to create like 1,000 of them within the next couple of years. They've already launched, a couple hundred at this point. So the number of funds like that is exploding. But I'm not aware of any sort of really obvious central repositories. But the usual sort of startup websites, Crunchbase and things like that, AngelList. Would probably have some good resources for finding them. And in terms of finding angel groups, the Angel Capital Association, angelcapitalassociation.org, I believe, has a pretty comprehensive list of all of the angel groups in the country. Have links, and they'll have some descriptions of where what their thesis is, what their target kind of investments are. Most people have a fairly clearly articulated view of that, because they want to make sure that they're not getting shown things that waste their time. Right, so they're interested in deal flow and want to make sure that the deal flow they're getting is relevant to what they're doing. All right, and I can see we're already past 11. I'd meant to break this at the hour. Looks like we weren't able to get any of the anyone to come in and do a 1-minute pitch, unfortunately. And sorry, this is Chrome only. I'll see if I can't work out how to make that happen, maybe just within YouTube, or make it easier for next time. I really appreciate everyone coming. Lots of great questions, fantastic interaction. So I will definitely schedule one of these again, and hopefully you'll be able to join us then. And so, all right, have a great day, and until next time, ciao.